Hi, in this video we'll cover revenue recognition. And so here is our outline, the order in which we'll cover things. So the key here is that there's a 5-step process to revenue recognition proposed by the FASB. The objective here is to recognize revenue in an amount that reflects the consideration that the firm receives or expects to receive in exchange for goods or services. Our first step will be to identify contracts with customers. It's usually pretty easy. The second step is to identify the separate performance obligations within that contract. So sometimes you have a contract with multiple performance obligations. For example, you get a haircut and it includes a wash. You wash your hair afterward. It's pretty nice. The third step is to determine the transaction price. Again, usually pretty straightforward, the amount of money that they charge you for. Step 4 then would be to take that transaction price and allocate it among the performance obligations. So for the haircut example, how much goes to the haircut and how much to the hair wash when the whole thing costs $25, for example. And the last step is simply to recognize the revenue as each performance obligation is satisfied. So identifying contracts with customers. A contract, an agreement between two or more parties that creates enforceable rights or obligations. It doesn't mean it has to be written. It could be oral or just customary business practice. Should I apply revenue recognition guidance to the contract? Well, it has to be an actual contract. So yes, if the contract has commercial substance. And I know that's something that's covered in Intermediate 1 towards the end of the semester there. Commercial substance has to be an economic reason for the exchange. This is one of those things, doesn't come up a lot, but if you exchange two assets just to get a gain for one company, and the assets are virtually similar, that doesn't have commercial substance. Anyhow, if it has commercial substance and all parties have approved the contract and are committed to fulfilling its obligations, really this is why a syllabus is not a contract. It is like a contract, right? Because the students never said they approved of it, so it's not a contract. Just an example, just to think about. The firm has to be able to identify each party's rights regarding the goods or services to be transferred. And make sure that the firm can identify the payment terms. And finally, that it's probable that the firm will collect the actual money. If those things are true, you have a contract and you're going to be applying the revenue recognition guidance to recognizing the revenue on that contract. But know if the contract is wholly unperformed, and this is the key here, each party can unilaterally terminate the contract without compensation. If that is the case, you don't have a real contract. A real contract creates enforceable rights or obligations. Enforceable. So it's like, if you fail to perform this service, we then have the right to collect our money, or some sort of fee anyway. If there's no consequence, if you just said that you're going to cut someone's grass and you don't show up, well, it's not a real contract. Should not be applying revenue recognition. And there's several types here of performance obligations. You could sell inventory, that'd be sales revenue. You could render a service, that'd be service revenue. Permitting the use of an asset like leasing assets or rents. You could sell an asset that's not inventory. That would be a gain or a loss there on disposition. And the timing of it, if you sell a product, usually you recognize it on the date of sale. Usually when you render a service, you recognize it when the service is performed and billable. For rent, it's usually as time passes or as the assets are used. And for gain or loss on disposition of an asset other than inventory, it's usually on the date of the sale or the trade-in. Okay, so then how many performance obligations? here we got Ford Motor Company sells cars to Riverside Auto Dealership at a price that includes 6 months of XM satellite radio, which is normally sold on a standalone basis for a monthly fee. So after that 6 months period, the customer can renew the services with Ford for a fee if they want. Okay, let's look at example 2. I know, just keep that example 1 in mind. Let's go to example 2. Best Buy sells computers that include a 120-day warranty. In addition, they also sell separately an extended warranty, which provides protection from defects for 3 years beyond the 120-day warranty. So the question is then, how many performance obligations do you have in each example? So the answer in both cases is 2 performance obligations, because they are not interrelated enough. Okay, they can both be purchased separately. So the XM satellite radio is typically purchased separately. Same with the warranty. The extended warranty there can be purchased separately. If they're very interrelated and dependent on each other, then you can account for it as 1 performance obligation. But in this case, you cannot. 2 is the answer. Step 3 is determining the transaction price. And I think we're going to pause here. We're going to call this the end of this video. We'll pick up in the next video.